The United States is on the verge of defaulting on its own debt, an event that could send shockwaves throughout the global economy. Markets are now recognizing the risks posed by tariff wars, global instability, federal spending cuts, and a massive budget deficit. Despite being the world's largest economy and a global superpower, the U.S. is struggling to manage its finances, raising questions about how it reached this point. The U.S. debt stands at $36 trillion, over 120% of its GDP, and is growing rapidly as the government spends more than it collects in taxes. The debt-to-GDP ratio is now 134%, highest over 150 years, surpassing levels seen during the Great Depression, both world wars and the COVID-19 pandemic. Since the 1960s, the U.S. has raised its debt ceiling 78 times. The debt ceiling, or debt limit, is a cap how much the government can borrow to cover its expenses. The debt ceiling was introduced during World War I to prevent excessive borrowing that could destabilize the economy. At that time, U.S. debt jumped from 3.5% to 30.2% of GDP. After World War II, debt peaked at 103% of GDP but dropped to 35.2% by 2007. However, recent decades have seen debt surge due to increased government spending, tax cuts, and declining tax revenue. The U.S. is one of the world's largest trading nations, but its trade balance has worsened in recent years. The biggest decline has been in net exports, driven by a steep increase in imports. Last year, the trade deficit hit a record $1.2 trillion. When imports rise, money flows out of the economy, weakening it further. Since the Trump administration announced major tariffs on many countries, businesses have been rushing to import goods before additional tariffs take effect. This has led to a surge in imports without a corresponding increase in exports, putting significant pressure on the U.S. dollar. The world is already losing confidence in the U.S. dollar, with countries like Russia, India, China, and South Africa pushing up efforts to use local currencies for international trade. The rise of the digital yuan, digital rupee, and the new BRICS currency could damage the U.S. dollar in the long run. Today, cryptocurrencies is being used for many transactions around the world. Consumer spending, a key driver of the U.S. economy, has sharply declined. Year-on-year growth has dropped to nearly zero, down from 2% last year. Surveys from the University of Michigan and the Conference Board show consumer sentiment and confidence decreases. Inflation is at its highest since 1995, and the Conference Board's Expectations Index, which predicts income, business, and labor market conditions, has fallen below 80, a level often signaling an upcoming recession. Business confidence is also weak. The ISM Manufacturing Index shows U.S. manufacturing stagnating, supported only by a surge in imports. Meanwhile, consumer spending is increasingly dominated by the wealthiest 10% of Americans, who now account for 50% of all spending. This means the bottom 90% are in a recession as their share of spending shrinks, with the stock market playing a larger role in the economy. Wealthy Americans holding most stocks in stock market. A recent market declines could further reduce spending, pushing the U.S. closer to a recession, while some of the spending slowdown is due to the pandemic, tariffs, and inflation. These factors are also hurting confidence. Economic uncertainty is weighing heavily on both consumers and businesses. The housing market often signals future economic problems. This year, home sales have dropped to their lowest levels ever, even lower than during the COVID-19 pandemic. Despite higher interest rates, home prices haven't fallen due to a lack of available homes and the prevalence of 30-year fixed-rate mortgages, which protect homeowners from rising rates. However, homes are now more expensive relative to incomes than ever before, making it difficult for many families to afford a house. This has slowed the market significantly. Many people can't move because they can't afford to refinance, and first-time buyers are priced out entirely. Home builders are also feeling the pressure. Sales are dropping, and the risk of mass deportations could hurt the construction industry. New tariffs on Canadian timber could raise construction costs, reflecting a lack of confidence in the market. Despite these challenges, the U.S. economy has many strengths over the past, including strong growth, innovative companies, high productivity, and high private sector investment. Every economy faces ups and downs, and the U.S. is no exception. While the current problems are severe, the U.S. has the tools and resources to solve these problems. The coming years will be critical for U.S. to revive its past economy. If you found this video informative, don't forget to hit the like button and subscribe to the channel. Thanks for watching, and I'll see you in the next video. Bye.